And now we're going to the next plenary. This one is in investing in responsible digital financial services in Africa. And it will be chaired by Margaret Bialas, the Global Practice Lead and Industry Specialist in Digital Financial Services at the IFC. Please give her a big round of applause as she comes back. I assured her that you would all go crazy for her like it's a concert. I'm turning to be a liar if that's the kind of applause you're giving. So let's try it for the rest of the panelists. Imtiaz Khan, Executive Director at Cassia Capital Partners. Thank you. Kevin Kamemba, Private Equity Manager for Africa at Incofin Investment Management. Jari Jang, Regional Manager, Africa and Middle East at Triple Jump. And Alexander Van Kuchen, Director of Policy and Outreach at Tala.
Thank you so much, and welcome to my panelists. I'm very glad you could join us today. I think there's one thing all of you have in common, and that's that your respective organizations, if not you personally, signed our guidelines for responsible investing in digital financial services. So we're very, very glad you did that. These guidelines have been developed by a group of investors over the last 18 or so months. And signatories include development finance institutions, private equity, venture capitalists, and we also have endorsers who are those that we typically would invest in, which Tala represents, Alexander Van Kuchen. And for us, it's very important that it's not just the investors, but also the investees who subscribe to them so that they understand and know what's coming and what we expect. The development of these guidelines was spurred by what we've seen happening in the markets, which has been an evolution more or less since 2008, where we see a lot of new money available for developing markets that maybe previously wouldn't necessarily have come here. Partially, this is because returns on more traditional investments have declined. Also, maybe investments in financial inclusions, we hope, have become a lot more attractive, right? We've seen a high of $37 billion going towards financial inclusion in recent years. Another $31 billion are invested in fintechs annually. And partially, I think that's also because disruptive technologies offer a lot of opportunities and break down barriers beyond just finance, sort of opening up also new sectors in energy, education, healthcare, et cetera, where we can increase inclusion because of digital finance. But what that means, this inflow of money, I think, is also that we've seen a lot of new risks emerge, right? And I think that's what the guidelines try and address, is how do we deal with these risks that relate to data privacy, fair and transparent pricing, understanding the kinds of products that you get, et cetera. And as Martin was saying in the earlier panel, they were discussing a little bit that we see in Kenya and other places signs of beginning structural financial exclusion because of money being very readily and very easily available. And all of these are things that I think have led a group of investors such as yourselves to really think about what can we do to influence this, right? And IFC in the past, through what we've done working with the SMART campaign, what we've done working with the G20 on our high-level principles for digital finance, has been thinking on different levels of how to set standards. And the sort of middle piece is really the investors. So in the digital space, I think with the high-level principles, we have addressed what policymakers and regulators can do with the certification program that the SMART campaign has. It goes at the provider level, and now with these guidelines, I hope we are getting to what we as investors can do, and we've done something similar with the Equator Principles and corporate governance standards in the past. So that's a little bit the background and the history to how we got to these guidelines. And 3 months in, we have some 80 plus or so signatories, with sort of the very first wave committing in May, and since then a lot of new ones signing up. And maybe to sort of start off the discussion, I would like to go to each of you and ask you to talk a little bit about your respective organizations and why you think these guidelines are important. What made you sign up for them, and what is it that you think you can do to affect change in the market. And maybe starting off with Incofin. So I'm not going from right to left. I'm going to hop back and forth, okay? Which is a fund and investment management company based out of Kenya. What made you sign up, subscribe? Why? What difference do you think you can be making?
All right. My name is Kevin. I work with Incofin Investment Managers. So Incofin has been there for about 20 years, and the basis of Incofin was it was an organization that was created from the perspective of impact financing. I guess it came up at the same time with the likes of Triple Jump and Blue Orchard Symbiotics. And the big focus there was how to have responsible investing, where you'd be able to then see a bit more, not just in terms of financial return, but from the impact perspective. Over the last 20 years, Incofin has grown. Currently, we have about 1 billion in assets under management, managed across 10 funds. And all this is across the different developing markets. One of the key things that we have as a strength for Incofin is the technical assistance. And it's through this that we try to then bring in this culture of the impact that goes beyond the money. So we bring in different types of things from training for the management team, for the board members. We try to bring in issues on the risk management. And more than that is Incofin has been a pioneer on social responsible investing, signing up to the SMART campaign. We're part of the pioneers of the series program for the SPA4. And what we try to do through our investments across the different markets and across the different segments within the financial institutions is that we have a keen focus on how does this impact then go down all the way to the grassroots. We have done various investments, both in equity and debt investments. And our bigger bias is towards the microfinance institutions, the smaller microfinance banks. The key focus is always from the perspective of how do we bring in impact and measurable impact. So for a lot of institutions, you will talk about being able to reach X% of women. Do you have a tool then that is able to measure that? And are you able to measure the kind of impact you have? And that ties in tightly with what the current Responsible Finance Forum does. For us, the key thing, and I think we just signed in last month, and we're very excited about joining the campaign. Looking at digital finance, one of the key worries has been in terms of the risk, especially to the clients. One of the things we're very keen, and what we like about being part of this forum is from the perspective of getting the practical knowledge and being able to interact in forums like this. To be able to look at it from the perspective, when you talk about over-indebtedness of clients, what are you doing when you get into the digital finance platform? Are you actually able to see what this money is being used for? And I think, I'm sure as most of the panels will have the discussion, we'll be able to see that it's not as obvious as it might seem, and it's probably a continuing thing, and over time, we would want to see a world where you're able to actually create impact, one that's actually measurable. Yeah, thank you.
Thank you for that. So impact investors, Jared, you are what one would say as a traditional impact investor, I guess. What do you think being a signatory to these guidelines can do for you, for Triple Jump, and what can you do for the industry?
Sure. Maybe first, apologies for not looking into the crowd, because these lights are too much for me. Yeah, I think, very much, I mean, the history of Triple Jump, I will leave it a bit for what it is, because I think we're, fairly similar to Incofin. And I think that there's three key things on actually these guidelines that we hope to achieve from it. One is affordability for the client. So that is certainly one of the key reasons for us to be involved on this, and maybe to draw the sort of analogy with microfinance institutions that we have been supporting over the past 12 years of our existence, is that within the 12 years that we existed, we at some point introduced an interest rate traffic light, which basically highlights for us whether or not we can invest in an institution. Reason for that is very simple. If it's not affordable in our perception, we will not invest. If it's high interest rates because of certain country conditions, or country being macroeconomic or political or or institutional conditions such as being very rurally exposed, we would have an argument to explain to our investors that interest rates are on the higher side. Second is better customer service, because we feel that being, and I guess in the earlier session several examples were mentioned on how you can achieve that better customer service through digital services. This is one of the other key reasons that we believe in the guidelines. And the third is, I guess, to eventually also be able to have a stronger outreach and a deeper outreach in areas that can otherwise less easily be served. And of course, the point that Andrea earlier this morning mentioned on having branches, I think that's a fair point, that it's still important for a client to be able to get to the institution, to speak to the institution. Nonetheless, in some areas, it will be much more difficult and much more expensive to be out there, and we hope that by providing these digital financial services in a responsible way, that helps to reach customers that otherwise wouldn't be reached. So these are the key three reasons for us to sign.
So Imtiaz, you're a very different kind of animal as an investor, right? As a private equity investor, what drives Cassia Capital to become a signatory, and what is your take on the guidelines?
So it's an honor to be here. I used to work with the IFC. That was about 10 years ago.
Which is hopefully not the only reason you came.
Nowadays, I'm an unapologetic, pure capitalist, chasing profit. So why am I here? And why do I think it's important to be part of the Responsible Finance Forum? Well, one of our best investments as Cassia Capital Partners was in the microfinance space. We exited a couple of years ago. It was a fantastic investment. One of the reasons we exited was we were looking at the business and the risks it was taking. And we thought the kind of return that we were getting relative to the risk that the MFI was extending was getting a bit out of balance. And we exited. We made a lot of money. The business is still alive. It's doing well. But it's not as profitable as it was when we were there. Partly because the risk-return equation is a bit out of kilter. And partly because you've got new upstart people like Tala and Branch coming into this space, making it more difficult for the traditional MFIs to compete. So for us, even when we are chasing pure profit motive, it's very important when we look at prospective and existing investments to make sure that they're responsible in their practices. Because it's with responsibility that you can bring down the risk in the investments that you look at. So by way of quick introduction, Cassia Capital Partners invests across the broader East African region. We call it the Tusker region. That's everywhere where Tusker is drunk. Tusker is the predominant regional beer brand. I'm biased because I'm Kenyan. It's a Kenyan brand. But it's also Tanzania, Uganda, South Sudan, Kenya, Ethiopia, Rwanda. We are sector agnostic, but we love the service industry. We love financial services. And we see financial services as the lifeblood of the economies across the region. Finance is the lifeblood of the economies across the region. And so we're very excited to be here. We're very excited to be promoting responsible practices. I'm not sure if that answers your question fully, Margaret.
We'll have time to go a little deeper, I hope. Yeah. So, but before we do that, I'd like to go to Alex, who is a little bit of a different animal to my other three panelists, because Alex actually represents the financial services industry with Tala, and potentially somebody affected by the way investors look at you and assess whether or not to come in based on the application of these guidelines. So I think my question to you first, talk a little bit about what you do, and then what motivates somebody like Tala to become an endorser of these guidelines?
course. And thank you so much for the opportunity to speak here. It's a real pleasure and honor. So Tala is a social enterprise whose mission is to provide access, choice, and control to financial services for the globally underserved. And we do that through an Android smartphone app that we use to assess the risk of people who are traditionally excluded from financial systems. So that's a little bit of background on us. We were one of the first digital-first lenders in the ecosystem in Kenya and have since spread to Tanzania and some other regions beyond. And I think for us, part of our DNA has always been responsibility to our customers, having a relationship with them seeing us as a partner, and understanding them constantly in a deeper way all the time. We invest deeply in that within the company. We have what we call our product impact and insights team, whose exclusive function is to communicate in an ongoing basis with our customers, do research with them, sit down with them, understand their challenges more and more. So when the guidelines were published, a few weeks ago, and other ongoing parallel initiatives like the SMART campaign came up, we always saw that as part of our DNA, and it's something that we always welcomed, that there's this discourse that we could participate in that we had always been having it privately, internally with ourselves. But something that we've seen in the 4+ years that we've been lending in Kenya is that despite us coming in and seeing both sides of this value proposition of being able to deliver on the promise of financial inclusion while also making a profit, and we've been successful in that to the point where other people have also followed. And it's a very robust, vibrant ecosystem now in Kenya. And in many ways, that's a good thing. It gives customers more choices. But at the same time, not everybody's approaching that proposition the same way that we do. And so increasingly, we see the need to have outside parties kind of bring this conversation to the fore about what it means to protect customers, to conduct yourself according to a higher kind of set of ethical principles. And our investors, who are primarily venture capital investors based in the US and elsewhere, have always kind of brought that up to us internally, but it's nice to see a broader set of institutional investors really bring this conversation to the fore. And I think when we look at Kenya primarily, but a variety of these other ecosystems, the raw material to have this kind of gem of a financial system in the 21st century exists. But if the pressure isn't coming from every side to make sure that that crystallization is happening in a healthy, ethical way, there's every chance that it could go down a route that isn't in the service of our customers, of companies like Tala or the organizations investing in us. So it's great to see that conversation happening from many different sides at once.
I mean, Kenya was mentioned in the earlier panel, and I think is maybe a case to come back to also in this discussion a little bit, because I think Kenya is the one place where digital lending has been growing the fastest, has been the most prominent, and I think where we are actually seeing these aspects of structural financial exclusion, right, where people find themselves blacklisted because they feel they've taken out a loan that they're not really aware was a loan to start off with. So I think there's a lot to be said about understanding, for customers actually understanding what kind of products they take out, that what has been pushed to them is actually a loan. So maybe starting off with Alex, what do you particularly, as a lender in that market, do to be transparent to your customers as to what the product is they're actually getting and making sure that they can afford it as well?
Of course, and I'd encourage anyone who's very interested to try our app and see what the user experience looks like, because it's available to anyone in one of our markets. But there are a few kind of basic principles that we've implemented since the very beginning of our time, and we continue to improve on those. I don't want to imply that we're resting on our laurels in any sense. We're constantly trying to understand better. But a good example of that is when somebody is approved for a Tala loan, they're shown all the terms of that loan on one screen together in a very transparent way. We break out how much they've been approved for, when they repay, how much of that is the principal versus the fees that will come along with it, when their repayment schedule is expected, what the repercussions are for paying late. And we offer that all on one screen before they have to actively accept that loan. So just because you've applied for a loan and you've been approved doesn't mean that you're going to get it. You have to go through all those constituent parts of the terms and really kind of confirm that you understand it.
Okay, so it's not a push loan. So Imtiaz, you said that one of the reasons you subscribing to this is because of increased risk you're seeing and risk mitigation, right? And that comes from your microfinance experience. Now, as an investor, especially in financial services in the East Africa market, When you look at somebody like a Tala or a microfinance institution, would you look for things like, do they do push lending, or what is the way they protect or inform their customers? So to go to what Alex has just described as their process, how deep do you actually look at the processes of your investees?
No, absolutely, Margaret. When we look at investments, one of the biggest things of value that we have, people look at us and say we've got lots of money and that's where our value is. And that's not where our value is. Our value is in our reputation. We lose our reputation, we've lost our future. So we very jealously guard that reputation. And therefore, whenever we're looking at any prospective investment, we take a deep dive into their ethical practices, into their policies, and we like to push them to become the best in class, sometimes in a controversial industry. So the MFI that we invested in used to give emergency loans. In other markets, they might be called payday lenders. And that's a dirty word in some markets. And we pushed them very hard to develop policies and procedures and standards on who they will lend to, how they look at affordability, transparency in pricing and the conditions attaching to the loans. We're very particular about that. Because if there is a blow-up, and there have been some in the Southern African space, to mention one, Blue, for example, lost its licenses in a few jurisdictions. This is a decade old now, so we can talk about it. And we are very wary of being caught up in an investment where you're sitting on the board, you're looking at the practices of the lender, and you might lose your reputational shirt, which means you lose everything if you're not careful about that. And just to quickly mention, so running Cassia Capital Partners is my daytime job. One of my nighttime jobs is as a non-executive director on Standard Chartered, listed in Kenya. Again, very, very particular and very jealous at guarding its reputation. So that's common right across the financial sector.
Okay, so we can welcome Standard Chartered Kenya soon to this guidelines too, right?
So we have policies on who's supposed to make public statements.
No, we are talking to Standard Chartered globally. So, Kevin, does that likewise keep you up at night as well, losing your reputation and hence losing your shirt? And what would you do to operationalize these guidelines? Because having guidelines on a piece of paper is one thing, but actually putting them into practice, right, in your daily lives is quite another.
Yep. So one of the things I think we do very actively across the entire investment process is internally we generally tend to have training sessions, and what that has done is even at a manager level, looking across the different markets and the investment managers will have quarterly trainings. What this helps us to do is even at the investee level, because as much as we take minority positions within our investee companies, we'll always tend to have a board position for us to be able to co-pilot essentially the investment through the different stages. So one of the things we do very deliberately is the continuous training of the investment managers, continuous training of the managers within the investee companies, and this is to help them to be able to have it within your DNA as a way to measure social impact, but as well things like client protection. So if you look at our screening stage, for example, at the point we're doing the screening stage, when we look at a business, especially looking at the incorporation of digital technology into finance. So one of the things we will look at is how are you able to measure the impact of that money? Are you able to actually go down to the person who is borrowing this money and be able to tell me my 40% of the people who borrow this money are actually women, and most of them earn below this percentage in terms of a salary. The big challenge, I think, with digital technology has become that a lot of people are able to have access to this money. So you'll find probably a larger chunk of your borrowers will probably people who can already have access to financing. And what do they do with this money? You'll read different articles about sports space. I think Kenya has a big, one of the largest betting populations probably that there is. Unfortunately, you look at government policies, they're not supporting this. I think the last government policy, they reduced tax on betting winnings, and then the increased taxes on things like M-Pesa and bank transfer services. So it goes contrary to the kind of market we would like to see over time. So our big worry is always, how are you able to measure that? You look at the kind of person, if you're trying to access the person in the grassroots, the people in the rural areas. One of the panelists earlier had spoken about, it's cheaper to now afford a digital phone. So if somebody is living in the rural areas, they probably have never had a bank account before. How are you able to check whether they are able to pay this? How are you able to confirm that you're actually not giving them more money than they can afford to pay? Are you able to continuously monitor your delinquency rate of your portfolio and understand what's driving that? So we'll keenly look through all these processes through the screening stage at the point when we come in as an investor, and more actively at the board levels. So we'll generally come into the business and we'll require them to have a certain metric or tool for them to be able to measure this kind of different issues.
That sounds almost like that's a question for you, Alex. Do you have those tools that you can actually measure that somebody who's never had a bank account before has the capacity to repay the loan? What are they using the proceeds for? Are they, like Kevin suggests, going out betting in Kenya? So how do you ensure that?
So in our underwriting process, we have a variety of mechanisms, both to kind of understand the online and device-specific behaviors that different borrowers might have. It's obviously a really complex portrait, because when people consider Tala and the need that we like to fill for our customers, the other tools that our customers might use for those same needs aren't necessarily digital or even traditional banking. They might be completely offline behaviors that are very difficult to capture. So I think to answer the question, part of the way that we understand customers' behavior is when they repeat with Tala and we see kind of longitudinal behavior after their first loan, what they say they've been using their loans for, why they need a higher limit, or when they intend to repay and how. We build that more nuanced kind of picture. We do have data-based approaches for also kind of analyzing cohorts as well, but it's really fascinating because, as you mentioned, Kevin, there are emerging behaviors that didn't exist 3 years ago. Sports betting is a fairly recent phenomenon in Kenya that we're still really trying to understand deeply. So it's to say that it's kind of like a give and a take, where we have to respond to behaviors that we're seeing from our customers, but we're also developing tools to better understand those same behaviors as they kind of emerge.
So speaking of tools, Jerry, you said that Triple Jump has an interest rate traffic light, which I think comes more out of the traditional microfinance investments. So are you thinking how this could be applied to the more specific digital lending space, or the realm of digital service providers? And I mean, maybe taking that one step further in terms of what do we do with these guidelines as a group of investors and operationalizing them? Is it something you feel you would want to share with a broader group that could be beneficial to Kevin and MTS as well?
Sure. Sorry. So maybe to the first, to how we are planning to operationalize this. We are currently conducting a due diligence on as we speak, actually, on not here, but in one of the regions where we operate, to a digital SME lender, where we try and pilot our ESG framework on the investee to see whether indeed the practices that we have established over time and with a lot of learnings in the more traditional space, so to speak, whether we can also apply that to newly arising more digital lending companies. So it's not yet like a fully established procedure, but it's certainly something that we are looking at to see how we can best apply the practices that we currently have into that new framework. On the interest rate traffic light, I mean, to put it very simply, many of the newly arising startups in this space are not going to be investable according to that principle. And for two very simple reasons. One is affordability for the client is perceived as, the interest rate is perceived as too high, and two, the circumstantial factors such as profitability, which is one of the aspects we take into consideration, and profit sharing is most likely going to be beyond our level of acceptancy, at least for the investors that we currently serve. The other aspect that is interesting to us is to see I think Martin this morning said, are they the walking dead? And I think one of the interesting aspects that we saw from a survey that we held last year with financial service providers in this continent was that basically the majority saw fintech as an opportunity and not as a threat. We had a slightly different feel around that, but it was interesting to see that mostly MFIs and we're not really of the impression that this would threaten their business model, and we think it will eventually play a much larger role. That's also why we are actively looking at the space and seeing how we can position ourselves and how we can be actively involved in implementing those guidelines with the institutions we work with.
But it sounds like you're not going to invest in fintechs anytime soon or in digital lenders because they won't pass your traffic lights.
We have investments in Colombia, India, and Jordan. So we are certainly working, and I'm not excluding that we will work with parties like Tala. We have had actually discussions with Suresh, who's on the left-hand side there in the crowd, and we're open to it, but it would need to fit within our mandates, and we would need to see how to position that. And then the aspects that Kevin mentioned earlier, what is the purpose of your funding, what does the client use it for, and also the interest rate would be certainly something to further speak about.
So if I could understand a bit more, I mean, is it a hard cap for an interest rate? Because the reason I ask is if you go to some of the rural marketplaces in Kenya, the market women will go out and borrow money in the morning, go and buy stock, sell it, and repay in the evening, and the interest rate can be as high as 100% a day. Now, in comes a fintech which is going to give them money at, there's one in the room which will do it at 6% a month. It's pretty high, but hey, compared to 100% a day, so I'm a hardcore capitalist here, but I also value my reputation. What should I do?
That's a very valid question, and to answer your first question, is there a hard cap? At the moment, for us there is, and the reason for that is, I mean, like you're mentioning, you're a capitalist. Our investors are, for example, a Dutch charity. They also have a reputation at stake. So, we serve the interest of the investor while also taking their principles in mind. And so that implies that maybe a certain portion of these clientele that could potentially be served are at the moment, for us, we haven't found the approach. So that is what we are trying to see, and that's why I'm saying we have looked at digital SME lenders invested into 3 digital SME lenders so far, consciously chosen them, and we're also at the same time trying to see, for example, with our current clientele, how we can better enhance their operations also by implementing digital financial services, so to also reduce their operating expenses, which in the end we hope will also help them to lower their cost to the end client.
I mean, this is a very interesting question because one of the key discussions that we had with the investor groups as these guidelines were being developed and evolved, and I think that we'll probably continue to have and need to figure out, is fair and transparent pricing, right? So that's one of the guiding principles. Pricing should be fair and transparent. But what exactly is fair, right? Is it in a given market? Is it on a global benchmark? So as we think about how we implement these guidelines, I think the question of fair pricing is going to be one that will keep haunting us. And indeed, the point you're making, if it's 100% on a day-on-day, isn't 6% infinite on a monthly basis infinitely better? But then in a global context, is that fair if you benchmark it against a regular microfinance lending rate? So what are your thoughts on that, Kevin? Do you worry about fair pricing?
I'd say probably two-pronged approach. The fair, based on the good example that MTS gave, I guess, is more or less relative from my perspective. So the concern on the rate of interest, we don't really have a hard cap like what Triple Jump would have, but would be on the profits that the business itself makes. If the business itself is running efficiently, then what amount of profits is the business itself making? And then the question becomes, if you're able to reduce the pricing, does that help then the mama mboga, who's the lady in the market, be able to reduce the pricing she would have subsequently sold her product at. The sustainability of it as well comes in from the perspective of when you're selecting the interest rate that you're going to charge, is it indiscriminate? How do you determine who is charged what rate? How do you check if this client, for example, and goes back to the point that I put across, that a lot of these people have never taken a loan before. Therefore, they will definitely not fall within the credit rating agency. And therefore, how do you determine what rate should I give? If one lady sells 3 times the volume of another lady, depending on the location of the market, how do you make those determinations? Do you charge a higher interest if you're coming from Turkana relative to somebody who's coming from Marikiti market in Kenya, for example? So how do you determine the pricing that you're going to give? But at the end of the day, I think that all boils down to the return on investing capital that you have within the business. MTS would be more of the, what we call the vulture. From my perspective, I think how we look at it is how excess is your return on invested capital, and are you able to then pass those gains on to the customer? Yeah.
So I see Alex is getting very
Yeah, those sounded like questions for us when you were posing those rhetorically. I was like, but yeah, I think you bring up a lot of really important points. For us, when you consider from a very top-down view that there are so many different flavors of lending, but within the narrow space which Tala currently exists in, which is unsecured digital loans of 1 month or less, even within that, you do bring up this question of how do you adjudicate risk within the groups of customers that we're serving and provide interest rates that reflect our assessment of risks that differ on an individual basis. And so one of the initiatives that we've brought to bear in the last few months is this idea of risk-based pricing, that not everybody, based on our assessment, has the same risk threshold, and therefore those borrowers who we anticipate being the best borrowers should be rewarded for that, and borrowers who we have less information on and are taking a larger risk in lending to might have a slightly higher interest rate to reflect that differential risk profile as well. And for us, like that's again like an ongoing learning initiative that we're doing internally, is to understand how we have to adjust that process.
Jerry, any of this helpful for figuring out how to apply fair pricing traffic lights to digital?
Yeah, maybe one additional point to make, and just to clarify, is that, I mean, a hard cap comes with certain circumstantial factors being explained. So one of them is indeed the return on assets. I mean, you know, if you're making a, let's say, 15% return on assets, then we'll ask you a few questions on how that came about. But so. I think what Alexander is mentioning on doing a risk-based assessment, and hence also providing some of the benefits that you get from the learning from your model and applying those to the end customer, that is eventually one of the benefits that you have if you have a lot of data and you have that algorithm that can determine whether what the risk of that client is, and you can pass that reduction of risk or cost of risk onto the client. I think that's an excellent step forward, and that's certainly something that we would encourage.
And just to tack on a small point, when we were becoming a signatory to the guidelines, one of the principles that we really agreed with is when you reduce your own internal costs, that those savings should be passed on to customers. And so one of the conversations we're having right now, including many of you with my colleague Suresh, is if we get access to, you know, debt funding that reduces our cost of capital, how is that reflected onward? And so that's something that we really subscribe to, the idea that when we can save our own costs, that savings should be reflected to the customer.
You'll pass them on. You'll pass the savings on.
Yeah.
To your borrowers. Okay. I mean, other risks that I think the guidelines look to cover is related to customer protection, so data privacy in particular, and managing risks where they are at the appropriate level, i.e. not passing risks that maybe the investor or the lender or service provider is best placed to manage down to the consumer. So those are two aspects maybe. On the data protection piece and privacy, any thoughts on what you can and want to do there? I mean, it's become a very viral issue. You know, 50 million Facebook accounts hacked most recently, yet again.
Yeah, I mean, that is a big issue. So one of the attractions of the digital finance space is the sheer scalability that you can have by moving on to digital channels. But with that comes the risk of you've got these huge databases of data, not just individual, sometimes even biometric data, but even spending habits, revenue patterns, spending on expenses and costs, profitability. You've got so much data, and if some of this data were to leak, and it doesn't have to be a direct hack, it could be somebody screen scraping your lending patterns and get an understanding of what a particular sector looks like in terms of spending habits and profitability. The implications can be enormous for privacy. So balancing privacy on the one hand, scalability on the other, and cross-selling across channels, conflation across different industries, that's a real issue where getting the right balance is not easy and it's very tricky. We have not found the answer to that yet. I am unfortunately have to report. But it would be interesting to see what the thoughts are for my panelists, what they think about that. It's something that keeps us awake at night.
Alex, have you figured out how to make sure that there's no data scraping, leakage, etc.? Because you sit on all that data.
We do, and for the moment, we primarily store and process that data in the cloud. I was recently at a CGAP-led panel on this exact topic, mostly because it's a global conversation that's going on. India has a data privacy and protection bill that's being debated. It's obviously being debated in Kenya as well right now. One point that resonated with me is that there are a million pretexts from both sides of the conversation about why you could believe onshoring data is the benefit for customer, privacy and protection, reliability, et cetera. The same arguments can be made from the other side. But an expert view that really resonated with me is, and I don't want to misquote this person, but the essence of it was the cloud on its worst day is still much, much more reliable than a client service solution on the ground. And when you have global corporations whose only job it is to store and maintain data securely, reliably, and at a cost level that's affordable for both startups like Tala, even younger startups than us that have less money to work with, to me, it seems like there are a million things you could do to continue to improve that solution, but that is clearly the solution that will work better for the industry side.
Sure, yeah, I think the security point of view is very, very important. Actually, I saw the benefits of it this morning. As I was coming here, I had paid for a coffee in Java House in Nairobi, came to the ATM at Dar es Salaam, and it blocked me. And fortunately, I had cash on me, so I went to the hotel, again tried to get a payment out, and also denied. So I was able to, through the application that they established in Holland, call my bank and ask them what's going on, and they said, well, it can possibly be that you have those two transactions. I said, well, it was actually me. So I mean, that's the benefit side of it. I guess the point raised by both panelists on the potential downside, it's tremendous, and also like yourself, we haven't seen the solution yet. So yeah, I'm very interested to hear more about it, but we don't have the magic.
I mean, Kevin, I'll let you go in a minute, but just as an advert for the afternoon, right? So there are 3 sessions this afternoon that will go a little bit deeper into the discussion around data protection, risk management, and what's the third one? Pricing. So I think there'll be time to explore a little more. I'm not sure that any of them come up with a silver bullet, but we'll give it a shot. Sorry, Kevin.
All right. So from my perspective, I'd say personally I've found it interesting that probably the new digital applications like Tala probably do a better job at data protection. But I think probably maybe it's largely on how they're structured compared to the traditional banking systems. when I look at a lot of the microfinance systems and how they use them, there's not much more security features built in, but that's probably because those systems came in before all the advancements that you have today. And when you look at a platform like Tala, one of the things that I like is the fact that before you take the loan, then you're able to click on the terms and policies before the loan is processed, compared to when you look at the traditional microfinance where clients still fill out the forms and nobody ever really flips to the back to read the terms and policies. So how do you then incorporate those two, and how do you ensure that people are still able to go through the terms and policies? In terms of the access to this information, if you look at the typical banking system, who is able to actually have access to this information? When the front desk person is taking a client's information and puts it into the database, who is then able to access that from the back end, and what are they able to do with that? But I think as more regulations probably come across, it always seems as if IT moves a lot faster than the regulations. Hopefully at some point there'll be a convergence. Yeah.
Could I just make one comment? The one trend that we've seen which has been very worrying is where prospective finance providers will ask you to opt in or opt out upfront. And sometimes it's not clear what you're opting in and opting out of, and then you're not sure whether you're going to get a call next from an insurance company or from Java if you paid using your phone. And I think the European Commission has done a good job on privacy. In this region, I think the regulators will need to sit up and listen, because the financial service providers are very smart at having everyone opt in into all sorts of things without realizing it upfront.
Yeah, on that point, I agree. And I mean, to your point, the terms and conditions, right? It's you click to say, I accept the terms and conditions versus flipping the piece of paper and actually reading them. I'm not so sure if that is really that much better. I mean, just think about Apple asking, we have upgraded and you need to accept the terms and conditions. Do you really have a choice, right? I mean, and I think that goes very much with pretty much any use case. If you want the product, will you really read the terms and conditions, or won't you just go and click because I want to continue to use my phone, that app, I want to have that Tala loan? While if I sit in a bank and actually have a piece of paper and I have to read through it, I'm not maybe more likely to do it. So thoughts on that? I mean, just opt in to all of the things?
Yeah, it's a big issue, and I think the way to get around it probably is to have continuous education of your clients and customers, and continuous outreach. That they're never going to read those conditions, whether it's on screen or even on paper. And if you're a responsible lender and you really take that responsibility seriously, then every so often you're going to reach out to them and say, oh, and by the way, this is how we handle your data, and these are the kinds of things that you typically opt into when you click something. I don't know if that helps, but I've seen some financial service providers trying to do that on a regular basis.
So Jari, as a responsible investor, do you push your investees to engage in financial education and awareness?
Yes, and maybe naively so, I tend to hope that at least our investees do go to the client and do explain, and also actively explain, to try to get the customer to understand what they are accepting. So I hope it's not a flip of a piece of paper, and I think that from the due diligences that we have done so far, that's also not the case. So it's actually a choice of the customer to accept a loan and to understand in their own language the terms and conditions that they are signing up for. So I hope, I hope that indeed customers are not, let's say, without knowing what they are accepting, signing off on a loan. And I think that our traditional microfinance institutions that we support are doing that. One of the conditions that we have for our investment is endorsing the SMART campaign. We look at their client protection principles, and we are, as Kevin mentioned earlier, also looking at how to implement the SPI4 into our standard procedures. So we are certainly looking at that, and it's essential part of our due diligence process.
Sorry, Alex.
I think just building off one of Jerry's points was we know how long a user spends on that screen in the app. And we also know of the people who open that screen, what proportion of them decide not to proceed versus do. So that information is something we're constantly evaluating, both to see if we can present it differently so that it resonates more clearly with the customers, or to understand the customers who don't continue, why they're not continuing, for instance. Do they appreciate what permissions we're asking for and disagree with them, or is there another reason like their internet timed out? So we look at that information really, really deeply. I think another challenge that we face, though, as a lender is, regardless of what standard we hold ourselves to in regards to client protection and consumer protection, which we take very, very seriously, in Kenya at least, we have dozens of companies that pose as us and reach out to people as Tala.
Oh.
So irrespective of every standard that we hold ourselves to in terms of contacting customers, they're still getting emails in their inbox. I've literally had a friend of mine show me on his iPad a direct email that he got from Tala, when we never send direct emails. We don't do email marketing, period, full stop. So it's a really difficult quandary when you become one of the preeminent players in the space and you have a target on your back, and then other people have a vested interest in piggybacking off the reputation you've built.
That's interesting. I think that takes us a little bit into the risk discussion, no? So other than protecting your own reputational risks, what are maybe key risks that you think that you or your investee companies need to deal with? I mean, we spoke a little bit about data protection, cybersecurity. Maybe Kevin, any thoughts on that?
Yeah, but before I answer that, probably back to the issue on the terms and
Sure.
policies. Given how adaptable, I'd say, IT is, probably one of the things that they should do is, I'm part of an organization where every year you have to sign up, and you have to sign up on a policy in terms of all the things that you agree to. And probably one of the things needs to be, instead of having a blanket terms and policy, to just have a stepped statement so that you accept each statement, which would probably push you more to read the statement than anything else. But in terms of the client protection, I guess, in many ways we'll work with the regulators, especially the central banks, and how one of the things I like, especially about if you look at like the Central Bank of Rwanda, is that they have incorporated an IT committee as one of the mandatory board committees, which has to be chaired by an IT specialist and has to be an independent person. And I think that in many ways will improve a lot in terms of how the banks are able to view client protection and how they handle the information from clients. I think it will make a big difference. So I'd say, depending on how much more the regulators help to support that segment, because it definitely always comes at a cost. And for the management of the bank and for most shareholders, they'll also be looking at their returns. So if the regulator is able to then as well bring in certain things that are a bare minimum that's required, goes over and above then what things like the SMART campaign is trying to do. Yeah.
And I mean, the SMART campaign was mentioned a couple of times. I know Alex of the SMART campaign is here. She's sitting in the back. So if people want to know a little bit more about what the SMART campaign does, do seek her out to discuss. Sorry, I wanted to go a little bit. We have 5 minutes left. I wanted to spend these last 5 minutes maybe looking at the risk aspects, because that was one of the core principles as well. And we'll have a session this afternoon that looks into risks related to this specifically. Thoughts, ideas, anything that keeps you awake? Jerry, you look like you have ideas.
Well, awake, I don't know. That's hard. But yeah, no, one of the things that does concern us, and I'd be interested also to hear your view on that, Alexander, but is on especially those the more newly arising lenders, let's say, is on simply the portfolio quality, and it's something that I'm not fully aware of the exact numbers of some of them, but I'd be very interested to, for example, from Tala's perspective, hear more on that. And what our belief is that, you know, with learning from systems, eventually you should be able to reduce your risk and hence have a better portfolio quality. And I'm not sure if that has lived up to its promise yet. So that's one of the elements.
Can I just make a quick comment on that? So as private equity investors, it's sacrilege to say this in this room, but we're terrified of fintech. And there are many reasons why we're terrified of fintech. So I mean, fintech brings efficiency, scalability, innovation. It's great that way. But then the risk the speed of innovation and new apps becoming redundant. I mean, if you look at Angry Birds product life cycle, 1 month, compared to railways, 200 years and growing. So we're terrified of that space because you can become redundant overnight. But just addressing your particular issue, the credit quality of the portfolios. So what we've found is when we've looked at businesses, you find young upstart innovators, very bright people, willing to push the boundaries of what's possible. And we look at the business and we say, who's in charge of credit risk here? And they're like, what's credit risk? We can innovate around it. We can have an algorithm to look at it. And so generally, we find techies who are really pushing the boundaries of what's possible. But we really wish they would partner with gray-haired people who'll sit on the board and ask the difficult questions around, have you thought about credit risk? Have you thought about governance structures around it? Have you thought about all the other risks that the gray-haired people think about more when the techies are just looking around and saying, which boundary do I demolish next? So that's one of the issues we found in the tech space, which leads to risk. And the other one is just the conflation of different channels and cross-selling opportunities across very many different industries, whether it's healthcare, quick-serve food, insurance and banking is a traditional one. And there aren't enough people who are thinking about cross-contamination from one side to the other. And so I'm always advocating team up the young, innovative techies with somebody who's thinking about the risk side of it.
Yeah, maybe one addition to that. I mean, in addition to the gray-haired, I think the other people to team up with is clients. And in one of the visits that I did to one of the companies that we invested in, it was a topic of discussion. Like, so what is the reason for your low conversion rate? And good question. Have you gone out to your clients to see why certain aspects of your service are so these are still things that within these startups are sometimes overlooked. I mean, it's like you say, they push the boundaries, excellent products and certainly good for the end customer, but sometimes just asking what the customer wants will make a tremendous difference, I think.
Yeah, and to those points, there are a lot of investments that we've made internally. One is that we bring in customers all the time to conduct workshops in our offices across the world, and we have dedicated user researchers in each market to work with customers to understand what they want and what they need and how we can customize our product increasingly with each product cycle, which is 2 weeks at Tala, by the way, to better serve their needs. And we've also broken out different competencies within our company where data science sits separately from credit, and they talk to each other all the time about how we assess risk, both from not a more traditional viewpoint, but from that kind of more experienced institutional view, and then also from the data kind of side of it. So those are two things that we think about. But in terms of risk for us, and this is primarily speaking with my policy hat on, it's that I think regulators that are looking at fintech, and rightfully so, are saying, how can we create an enabling environment that also protects customers? And from a customer point of view, in many of our markets, there are dozens of options that if you search for digital loans in the Google Play Store that are going to come up. And they're not all equal, and they're not all going to treat you the same way as a customer. And it's very hard to understand the differences between them, particularly if you have no experience in the formal financial system beforehand. And so one of the things that does keep me up at night is making sure that our customers can discriminate effectively between the options in front of them and understand what the best choice is for them individually. And I think we as a company, constantly are trying to be transparent about what our product is, what needs it does or does not fit with our customers, but ultimately they understand how our product can be one tool of many for them, but it's a question of them fully recognizing the trade-offs with each. And when you have a very hot ecosystem with a lot of startups that are not thinking about all the same questions that everybody here on the stage has brought up, it creates a situation where everybody needs to be working together. Otherwise, customers are going to suffer.
And how many grey-haired people on your board? Kevin, one last thought on risk? Nothing? Okay. Then I would like to wrap this up. It's a super interesting discussion. I hope we can continue it over lunch, coffee breaks, in the evening. Please thank my panelists for this wonderful discussion. We'll go.